We all start out stupid. We all start out looking at tables like this, try to find out what's the best altcoin to buy. Will this thing do 10x? Will that thing do 100x? This is how we all start, but it's not okay to stay stupid. Many people got burned with the altcoins. Many people underperformed Bitcoin, Ethereum and Solana. But in the end, what really matters is the macro. How is the cycle in general developing? How are capital flows developing? Because there are two reasons why those US dollar prices of altcoins do not matter at all. The first reason is just opportunity cost, as in we can simply buy Bitcoin and get crypto exposure. We only get into a risky altcoin because we're going to get more return than just buying Bitcoin. If we don't get that additional return, then we shouldn't buy the altcoin. That's why we have to look at relative valuations to Bitcoin. How much is the altcoin outperforming or underperforming Bitcoin? That's reason number one. Reason number two, however, is that it's not just the opportunity costs within crypto that matter. Actually, the US dollar price doesn't matter because we cannot hold US dollars long term. Holding the dollar is really no alternative, especially once we've reached a stage of wealth where investing actually becomes important. This here is the US money supply. And very few people have actually looked at this and wondered, how quickly is this over time growing? It seems like there's some inconsistency in the growth, but really that's not true. Once we look at this on a logarithmic scale, this is pretty much a straight line up into the right. So the growth rate is somewhat constant, and it is at 6.8% per annum. If you don't invest your money, if you just have US dollars in the bank account, you are losing 6.8% every single year. Now, this does not matter if your net worth is only a few $100 or a few $1,000, but once investing becomes interesting and we get into the tens of thousands, hundreds of thousands of dollars, then those 6.8% do matter massively. Thus, we can't use the US dollar as an alternative to buying and selling cryptocurrency. US dollars don't matter. The US dollar denominator is going down over time very quickly. Here is how strong this effect actually is. 6.8% on $100,000 is $6,800 per year. That means every single day, if the dollars are not invested, you're losing $18.63. So instead of just ordering takeout every day, you're instead destroying that value due to inflation, due to the money printing. $18 every single day for every 100K. Now, if your net worth is only 10K US dollars, you obviously have to divide this by 10, so it's only $1.86. That's not that much of a problem. Still, per week, it's roughly $10 worth of purchasing power that you're losing. But this also gives a rough idea at what point in time it actually is important to look at investing. When you're still young, when you didn't yet have enough time to accumulate wealth due to savings, then really the main focus should be on increasing income. It should be in increasing the savings rate, having several months, potentially several years of income saved up. At that point, it makes sense to then invest. But before that, all the focus should be on increasing skills, on upping potentially the position in a company, on generating more cash flow, because that cash flow then can be used for investments. It really does take money to make money. But once we have net worth, investing becomes pretty much a necessity. Keeping the money uninvested is incredibly expensive, and it becomes more and more expensive over time. Thus, using the US dollar as a comparison for any investment makes no sense at all. And that includes also the altcoins. Now, there's another important takeaway from this. 6.8% monetary debasement every single year does mean that most people tend to struggle more and more over time, because most people do not increase their income by that rate. Here are the official numbers by the Federal Reserve in the US. The household income in 1984 was $58,930. In 2023, it was $80,610. It was higher, but how quickly did the household income increase over time? The answer is only by 0.8% per annum. So every single year, the median household in the US lost 6% purchasing power. So it's not just a subjective feeling that things are getting harder. It indeed is getting harder to buy that house, to buy that land, to potentially retire and live off the savings. And so I'm extremely skeptical when it comes to long-term statistics that involve US dollar numbers, simply because the US dollar is depreciating that quickly. For example, the US GDP. The US GDP is measured in US dollars, and of course it goes up over time. But are people better off today compared to, say, 30 years ago? Do people really have a 4 times higher living standard? I doubt it. Have a look at this here. This is the US GDP relative to the monetary base. Now, isn't that an eye-opener? When we take away all of the devaluation of the US dollar, we just assume we've got a steady US dollar supply, then actually the GDP went down. Everything was still going okay up until the end of the 1990s. And since then, relative to the monetary base, the US GDP has fallen by 37%. The current generation has it worse compared to their parents. So let's say the 30 to 40-year-olds, they have it much harder today compared to their parents. They've got a lower living standard. And this, of course, can be an explanation for all kinds of political issues, right? Why people become more radical, why birth rates are going down, and why there's societal instability. Now, this is already bad enough. The average Joe is having it worse. But there are still some outperformers. There are still some people that make money, that are able to save, that are able to invest. The problem is that even those people, most of them will get a double whammy. They will also lose their money, most of them. And here is why. There is this common narrative that if we are frugal enough, if we save, and if we simply just buy the S&P 500, that over time we will still get ahead, right? So if you're simply just working hard enough, if you are above average, you should be okay. Just take away the money. That's at least what's shown with charts like this. This is the S&P 500. And of course it goes up over time because the US dollar is devaluing over time. We've got the exact same problem that we already had with the GDP. So let's do the exact same exercise. Let's divide the S&P 500 by the money supply to pretend there is a constant money supply. Then we get this chart here. This is a very long-term chart. It starts in 1959. It tells us a very different story compared to conventional wisdom. Conventional wisdom is just buy the dips, the S&P 500 will recover. And while this is true in US dollars, it's not true in purchasing power. At least it can take a very long time. From this top over here to the recovery, it took 36 years. How much can we go down relative to purchasing power? This is 73%, and this drop over here is also 73%. People always say that Bitcoin is so risky because it can drop 70 or even 80%. But nobody says that after 4 years on average, we tend to have our purchasing power back. With the stock market, it can take much longer, and the drops are exactly the same if we look at monetary debasement. Now, one could still make the argument that the S&P 500 does generate some return, right? Not much, but still some. The chart over those 65 years went up by 53%. But then there's a problem with data like this. This is the historical Shiller PE ratio. So we're looking at the price to earnings ratio of stocks. When we buy stocks, we're essentially buying the future earnings of a company. So the price to earnings ratio just measures how much are we paying for those future earnings. In theory, this should be at an equilibrium. In theory, we should be hovering around some kind of a stable number. And here we are at an historical high. We now pay 38 years of earnings whenever investing into stocks. And we have seen quite a bit of volatility in the past, right? This was crashing by 25 PE points. And over here, we had a drop of 20 PE points, roughly. So seeing this ratio potentially coming down to 20 again wouldn't really be that much of a surprise. Maybe even go down to 15 or maybe, God forbids, to 10. A price that we saw in the 1980s. This is where I was born, by the way. So my parents experienced a 4x in growth in the stock market. That wasn't necessarily justified. That was just price appreciation, not earnings appreciation. Now, this is a crypto channel. Why am I talking about these things in the first place? It's because we have to hedge ourselves to a degree. Once investments become interesting, because we've got tens of thousands, hundreds of thousands of dollars in the market, we cannot just bet everything on crypto. We cannot necessarily afford to drop by 60, 70, 80% in our purchasing power. We have to diversify to a degree. The question though then is, what should we buy as a diversifier? And I don't think the answer is Nvidia stock. Instead, the answer is buying something that's risk off. We've got so much risk exposure that we should have something risk off to balance this out. Have a look at the historical ratio of gold to the S&P 500. This chart starts in 1890, and if the Schiller PE ratio drops by 50% or maybe even more, then there's a good case to be made that gold will at least double relative to the S&P 500, potentially even more than that, potentially getting to the long-term historical average, which is this dotted line. That would imply an outperformance of gold relative to stocks by more than 200%. When we buy gold at the right time and we sell it at the right time, there is outperformance to be made of 1,400% over here or 800% over here. When instead the S&P 500 is bought at the top instead of gold, there's an underperformance to be made by 93% over here or by 89% over here. And again, stocks currently, relatively speaking, are expensive relative to gold, relative to the future earnings, and also relative to the money supply. One could make the argument that some silver might make sense as well, because silver relative to gold is also cheap. This is the silver gold ratio. Again, a very long-term chart. It starts in 1932. And we did have times where we went up from the current price level. And that was an increase of almost 500% to the top. So in a way, it works a little bit like insurance. So the idea is that in case things turn bad, we won't completely blow up our wealth. We still have something left over that we can potentially invest. But it also means that because of that coverage of the worst case scenario, it enables us to take on more risk with the risk on side of our portfolio. So if we don't have any gold, we might be a bit more cautious in buying Bitcoin, in buying crypto. But by owning some gold on the one hand, where we've got something risk off, we can then suddenly also start buying more risk on things as well. And this overall then increases expected return of the entire portfolio. So there are two arguments here. The first argument is that the correlation coefficient of Bitcoin, the Bitcoin price at the top, relative to gold is close to zero, right? So the correlation coefficient is here, this squiggly line. Bitcoin and gold tend to not move in the same direction at the same time, which makes it a nice diversifier. The same is true for silver, by the way. The correlation coefficient of Bitcoin to silver is also close to zero. So both assets work very well as a hedge against our risk on investments. We can buy more risk on, and at the same time, we also have more hedge. And so the fundamental idea is that when we combine a portfolio of different assets, that the overall volatility of our wealth goes down. It's not going up and down that much anymore because we've got two uncorrelated assets. So check this out. The S&P 500 is here in white. It saw a massive COVID crash. But then in green, we see a combined portfolio of gold and the S&P 500. It almost performed equally, but the crashes are much more buffered. And this, of course, always is a nice thing, right? We want to see our wealth fluctuate as little as possible. So that's the wealth preservation idea. But there's also an idea for everybody that wants to get more risk on during crashes. So instead of just hoarding cash on the sidelines, hoping for the crash and then buying into the crash, instead we can have two uncorrelated assets and just shift them around as one thing crashes. So let's say the stock market suddenly crashes, but we also own some gold. We can then sell some of the gold and buy the stock market with it. So again, this is the S&P 500 to gold ratio. And if you had a lot of gold at the beginning of the 1980s and you converted this mainly into stocks, you would have been able, in the best case scenario, to grow the wealth by 30x in the span of 20 years. So we have mainly stocks whenever we are low, we have mainly gold whenever we are high on that ratio. And currently we are rather high on the ratio. So again, owning a lot of Bitcoin and owning a lot of gold, I believe, is the perfect combined portfolio now. It's not anymore stocks with bonds, it's crypto with gold, in my opinion. This is just what the numbers tell me. And here's the problem. There's just so much correlation within crypto, right? Everything is going up or is going down at the same time. For example, this year, everything went up. But during bear markets or during shorter periods of time, everything can also go down. So it seems like it doesn't even matter that much what kind of altcoin we pick here, right? It seems to matter more what's going on in the macro. Where is capital shifting? Does it make sense to study all of those white papers, to study all of those tokenomics, to study all the details and the founding team and the investors of all of those cryptocurrencies when in the end they all go in the same direction at the same time anyways? I actually have a background in finance. I studied financial analysis and investment management in Hong Kong at HKUST. And over there, we learned about the concept of correlation within asset classes. This is not something that's unique to crypto. This also happens in the stock market. And there are quite smart ways to manage this actually. What we're seeing over here is now an example with the stock market. So in green, this fat green line, that's the Nasdaq 100. But then we've got these other squiggly lines and they tend to move in the exact same direction at the same time, as we also see with the altcoins in crypto, right? The red line, for example, is Amazon. This pink line is Google. This purple line over here, that's Microsoft. So they all behave the same, even though the business models are really not the same. What I've learned in university is that there's a common approach called delta neutral investing. So we want to bet on an asset, but we want to take away the overall macro environment. We don't want to speculate on where the overall macro is going, if there will be a bull market or a bear market. We are just certain that one asset will do better or worse than another asset. So let's say, for example, here, we've got the Nasdaq 100 in green and we've got Netflix here in purple. And when the Nasdaq 100 is going down, then Netflix is also suffering and vice versa, right? Again, we've got all of that correlation happening. And we don't want to bet on the overall macro. We're just certain that Netflix will do better, for example, right? Let's just play with that assumption. What we then can do is we can go long Netflix and we can go short the Nasdaq 100. So since all the assets correlate all the time, once we go long one thing and short the other thing, we're suddenly canceling out the overall macro environment. So it doesn't matter if the market as a whole is going up or is going down. We are only speculating that Netflix in this example will do better than the rest. And suddenly, when we look at Netflix relative to the Nasdaq 100, we've got quite constant outperformance. And we can also at least get somewhat of an idea at what point in time Netflix might be cheap or expensive. So this is a completely market neutral chart. Just compare this with the Nasdaq 100, right? Those kind of moves to the downside or to the upside are not correlated with the overall Nasdaq 100 chart anymore. The Nasdaq 100 can crash massively while this relative valuation doesn't move much. So we're really taking away the macro. In other words, we don't have to think about anymore where the overall environment is going. Actually, now our idiosyncratic knowledge about a single asset can be turned into money without being exposed to whatever is going on overall. For example, let's say you've got the following thesis in crypto. You look at the different decentralized finance protocols and you think that Aave as a borrowing and lending platform has a lot of growth. So this is the total value locked or the capital that's in the Aave platform. It's growing quite a bit. And your bet is that Aave is better than, say, Balancer. This is BAL. This is total value locked of BAL. It's not growing that much. So your thesis is that because of that, the Aave token should also do better than the Balancer token. Here's the Aave price in US dollars. Sometimes it's going down, unfortunately, because the overall crypto market is going down. But Aave relative to Balancer is not going down that much. It's just going up. This is now on a logarithmic scale. Here's the same chart now on a linear scale. Isn't that nice, right? This is really constant growth. It looks much better than buying Aave directly, right? This is going up and down and up and maybe down, who knows, based also on the overall macro. And this is what investing is all about, right? We want to get the best risk-adjusted returns. We don't just want to make our 5 or 10x. We want to make this with as little volatility as possible. We don't want to crash 60, 70, 80% in the meantime if we don't have to. And there are ways, again, to mitigate the risk. We can cancel out the overall macro. And so there's another reason why Aave is doing so much better than Balancer. Have a look at the number of circulating tokens over time. This was at 13 million. And yes, over the years, over 4 to 5 years, this grew to 15 million. But still, this isn't really that much growth, relatively speaking, right? It's maybe 20% or so over the course of 4 to 5 years. But then compare this with Balancer, right? This started out at 19 million tokens, and this grew all the way to 69 million tokens. And that happened over a similar time frame. And so this is the perfect setup for a relative valuation bet. This is my preferred way to bet on any market, in crypto, but also in the stock market. The idea is that we don't want to predict where is the stock price itself going, where is the altcoin price itself going. We don't have to predict this because we don't know what happens with the overall market. Instead, all we need to do is we have to say A is likely going to be better than B. And so we go long A, we go short B. And tokenomics, as in an expanding supply in the altcoin market, is always depressing many altcoins. Just have a look at the weekly issuance in the altcoin market that are here tracked by Tokenomics.ai. It's almost 1 billion every single week. If there's not 1 billion of additional demand for those altcoins every single week, then the altcoins go down. And so I'm following this strategy already for quite a while, roughly 4 years, and I've also opened a copy trading strategy 1 month ago. Now, due to high demand, unfortunately, I had to close future deposits, but just goes to show how nice and constant we can make money with this approach. This is now annualized 74%. Yes, it's not a 10x every few months, but it's much faster growth compared to just investing in stocks or even Bitcoin and Ethereum for that matter, long term. It's all about risk-adjusted return, right? The maximum drawdown here was 2.6%, while we are analyzed at 74%. So the premium members that signed up on time, they're getting exactly that return. But since the deposits are now closed, most people are now manually trading whatever I do. And so I try not to promise anything unrealistic. Most other YouTubers, they just say, here is the next 5 or 10x altcoin. But those altcoins, more often than not, they simply just come crashing down. I just try to compound the current wealth as quickly as possible without taking on too much risk. And yes, there is a slight learning curve to this, but it's all doable. All you have to do is watch 2 major videos using perpetual futures on Hyperliquid to bet on relative valuations, and then also, at least as important, risk management with relative valuation bets. Because again, you don't want to gamble with 50x leverage your entire portfolio and then lose it all. You want to constantly grow with little volatility because the venture capitalists and the insiders are dumping on retail constantly with their newly created tokens. This is how we make money. We put ourselves in the same shoes as the insiders. We make money like the insiders do. They dump on retail, we dump on most retail holders as well, because most retail holders just buy on spot and hope for the best and then lose in the process. They might not lose as much in the current market where everything is going up, but most people still, even in a market like this, do underperform just buying and holding Bitcoin and Ethereum. After you have watched those 2 videos, I'm simply sharing all my trades as I'm opening and closing them. And you can just blindly copy trade, but of course, ideally, I prefer if you continue learning more and more, because I do believe that crypto is not just a game of luck, it's a game of luck and skill. And the more skill everybody has, the more edge we can carve out of the market, the more money we can win against others. Premium is currently $125 per month. If you don't like it for whatever reason, just message me within the first week and I will refund you 100%, no questions asked. If you decide to sign up even for the annual membership, then you will get priority access to the next copy trading pool. So I will open another copy trading pool at the beginning of next year, and all the annual subscribers will get access to that first before it closes, of course. A link to Premium should pop up directly over here on the screen. Just click on that. It will lead you to the website. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers!